Hey, what's going on YouTube? And welcome back to Tech Conversations. I'm your host Guillermo. It is October 12th. Hope you're all having a great day today. As you can see, it is a green day for me, up $280 today, or about 0.25%. So we'll see what the rest of the day brings us. Now in today's video, I want to talk about how to make weekly income on bearish stocks by using the poor man's covered put. So before I get into the strategy, all I ask is that you guys hit the like button down below and subscribe, guys. It really helps out the channel. Let's talk about our goal here. So our goal is going to be to benefit from bearish price movement in the underlying stock with limited risk and less capital than a regular covered put. Okay. And so the ideal situation here then is we are at least long-term bearish on a stock. Even if the stock is short-term bearish, we can also make money here, but at least long-term, you're bearish on a stock. Long-term, you expect the stock to drop in price. And so, for example, one stock that, you could have used this on in the last few months is ticker symbol HYLN, because if we take a look here in the last year, it's down almost 80%. So this would have been a great candidate. There's a lot of stocks like this as well. There are a lot of stocks you can use this strategy on. And so basically we want to short the stock, but without actually borrowing the shares and shorting, because shorting is a very risky strategy. A lot of brokers aren't even going to allow you to short. But also we would like to generate consistent income weekly while we wait for the stock to drop, right? Because ultimately the stock's not going to drop overnight. It might take a couple of weeks, it might take a couple of months, and we don't just want our money to sit there. We want to actually collect money as well while we wait for the stock to drop. So what I'm going to do is I'm just going to choose a random stock here. I'm going to choose ticker symbol SONY, Sony. Let's just imagine that I think Sony is going to go down in price over the next few months. Let's say I'm bearish on it. Let's take a look here at how we could use the poor man's covered put on Sony to, again, generate consistent income every single week. Again, always be cognizant of commission fees because, again, commissions on some brokers might be high. We are going to be opening and closing various contracts, potentially weekly. So always a good, thing to know what the commission fees are. Make sure they're not eating away at too much of your profit. But anyways, let's go into the options here for Sony. Let's take a look at how we can implement this strategy. Now, as the name suggests, poor man's covered put, this strategy is going to involve put options. So I'm going to go over to the puts here. And so the first thing that we're going to do is we're going to buy an in the money put option in a longer term expiration cycle. So our expiration date is going to be quite far out. It should be at least a year, but you can use this strategy with even shorter dated expirations, right? So what I'm actually going to do here, if we take a look here, I'm going to choose June 17th, right? Which is not exactly a year, it's a few months out, but it'll still work by using this expiration date. So I'm going to go over to June 17th, 2022. And again, like I mentioned, we want to buy an in the money put option. The deeper in the money, the better this is going to be, because the more it's going to act like we are shorting 100 shares. And also the less theta will be, theta decay, right? Because remember, when you buy an option, every day the contract loses value from theta decay. So again, we want to go deep in the money here. Remember, in the money for puts is where the strike price is higher than the current share price. They're also going to be more expensive. So I'm going to go up and I want to find an option that has a delta of at least 0.9, close to 0.9. So there's this one here that's almost 0.9. So you can see theta, very minimal on this one. So I would go ahead and buy this put option here. And it is going to be, obviously, it's going to cost some money, but it's not going to cost as much as if, we were actually shorting 100 shares, because again, remember that would have, there's way too much risk with that. So we're going to go ahead and buy this put here, and it's going to cost about $4,235. This is a deep in the money put option here. Now let's take a look at what this would look like now. So let's just go over to option strat. Let's just look at what this looks like on its own firstly. So I'm going to go to build. I'm going to go to long put here. And then I'm going to go up here. We're using ticker symbol SONY. And then we chose June 17th as our expiration date. We bought the put at the $150 strike. So let's take a look here. So our max loss, of course, is going to be the money that we're paying to buy this put option, right? Which over here it says is about $4,210. Our max profit, almost $11,000. And of course, that would happen if, Sony went all the way to $0. It's not going to go to $0, but that is theoretically our max profit. And it tells us our break-even price on the expiration date. So this is what it looks like here, guys. Now let's take a look at a couple of other things. So, this is great. Obviously, like I mentioned, you don't have to wait until the expiration to make money. We can make money prior to the expiration, as you can see here. Like, for example, if on November 18th, Sony's at, let's say, 104, right? We would be up $427. Obviously, you could close out at that point if you wanted to, take your $427 profit. You don't have to wait until the expiration, right? We know that. However, right, what happens if Sony just keeps trading sideways? Because right now it's at 109. So what happens if it just keeps trading sideways for a while at 109? You're not making any money, right? And the money you use to invest in this is just sitting there. It's not doing anything for you. It's not making you money. And so this is where this next step comes in. This next step is going to allow us to generate money, potentially weekly if that's what we want, while we wait for the stock to actually drop in price so that our long put option here makes us money. So we're going to go back, and here's what we're going to do after we've done this. So we have our put here that we've bought, right? And basically, the problem, again, like I mentioned, is that it might take some time for us to actually make money with this long put, especially if the stock trades sideways, doesn't drop as much as we want it to, or as quickly as we want it to. So why not, while we wait for the stock to drop, make some extra money weekly? And we can do this by selling an out of the money put option in a near-term expiration cycle. So what we can do here now is switch over to sell put, and what we're going to do is we're going to sell an out of the money put option, and you preferably weekly. Obviously, you don't have to do this weekly. If you want to do it monthly, you can do that as well. Again, depending on commission fees, right? Commission fees might be big, but let's just go to October 22nd. So we go over to October 22nd here, and we could sell a put here. So I could sell, for example, this put option at let's just say like the $100 strike, right? And for selling this put, what's going to happen? I'm going to get $23. $23 for selling this put. So what's great about this is, of course, our max loss is going to start to become less and less and less, right? And so this is going to be how we complete our poor man's covered call. So we're basically going to collect premium, potentially weekly if we want to do it weekly, while we wait for the stock price to actually drop. So our max loss here is going to be the debit paid to enter this trade, right? The money we're paying to buy this long put option, minus any premium that you receive from selling these out of the money put options. Our max profit, since we have different expiration dates here, it's really hard to determine what it's going to be. But ultimately, let's take a look here visually at what this would look like. So let's go to a new tab here for option strat, and let's take a look here at this poor man's covered put that we set up. So again, we're using Sony, SONY. So we'll go to Sony here. So the very first thing, again, we're buying this put option. So we chose June 17th for that. We chose the 150 strike. Now what I'm going to do is I'm going to add expiration, and this is actually going to be our back month expiration, right? And then what I'm going to do is I'm going to go ahead and add an option here. So this is the one expiring on June 17th, the long put we're doing. And then remember, we're selling a put using the front month expiration to basically generate some premium for us, potentially weekly, so that in case, again, the stock doesn't move a whole lot, we don't just sit there and not make any money. We can still make money here. So what I'm going to do here is I'm going to sell a put. Remember, we sold the put expiring on the 22nd at the $100 strike. So let's go back here. So $100 strike expiring on the 22nd. So this is what this would look like here now, right? And as you can see here as well, we can still make money from the stock dropping before we even hit the expiration date over here, right? So this is actually just showing us until October 22nd, which is when the put that we're selling expires. Now, of course, since we're selling this put, right, and the stock drops below this price, there's going to be a risk of assignment. And if you are assigned, of course, this long put option is going to be exercised to cover that assignment. So our max profit here is going to become capped. So ultimately, when you're selling these puts, you may actually not want to be assigned. So you might need to be very careful with what strike you're choosing when selling this put. But either way, still making a profit of $850 in a few weeks is pretty good, pretty nice profit here. And ultimately, like I said, if it doesn't do anything, if it does keep trading sideways, well, we actually just ended up making an extra $24 in less than 2 weeks. And you can continue to do that every single week, every 2 weeks, continue to collect $20, $30, and you're basically making money while you wait for the stock to actually drop in price so that your long put option goes up in value, right? And so again, ultimately by selling this put every single week, you're collecting premium. Your max loss is going to keep going down, right? So our max loss over here was $4,210. Now our max loss is $4,177. Why? Because again, we just collected $23 in premium by selling this put. So again, very similar to the poor man's covered call, but here you're using puts. And since you're using puts, this is going to be bearish strategy, where poor man's covered call is a bullish strategy. But as you can see, this is how you would use the poor man's covered put to basically make money off of stocks that you believe will drop in price in the next few months. So anyways, if you have any questions about anything I just talked about, feel free to leave them in the comment section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.